Good afternoon, everybody. We're going to give it just a couple more minutes so everyone who's not here yet has a chance to log on. Okay, folks, we are going to get started here. To those of you who are just logging in, welcome to GuideStar's webinar on what you need to know about setting executive compensation and how to make the most of GuideStar's compensation report. Before we get started, we're going to cover just a few procedural items. Number one, we are recording this webinar, and we will send the recording out at a later time, so you'll have a reference here. If you want to share it with your colleagues or you want to watch it again, you'll have it on hand following the webinar. We are also going to have a Q&A session at the end of this webinar, so if you have questions, feel free to ask them throughout the webinar. No need to wait until the end. In the little questions panel in the GoToMeeting panel that you're seeing on your screen. Now, before we get started here, just a couple of quick introductions. There's me on the right. My name is Jesse Breaux. I'm GuideStar's marketing manager. And our star of the show on the left, Holly Ivel, she's going to be the one leading the presentation today, and she's GuideStar's Director of Data Services. And with that, Holly, we welcome you to kick off the presentation.
Great, Jesse. Thanks very much for the introduction and the welcome. I'm really excited to be with you all today talking about this important subject. Before we move into the body of the session, I need to take a moment to go ahead and read a disclaimer. The information provided during this presentation is not to be considered legal advice applicable to any particular situation, and organizations needing specific advice and counsel on these matters should always consult with a knowledgeable counsel. Okay, so that being done, we're going to cover a number of key topics today: why we care about how we set executive compensation, knowing the rules around setting compensation, some of the key factors to consider when you're setting compensation, what some of the sources of comparable data are that could be used in that process. But what I'd like to do first is start with that question of why. And before I tell you why we think you should care, I'd like to hear from each of you about why you care about this topic. And we're going to take a minute and use that question box that Jesse just mentioned. And I would just like to get your thoughts on up on the screen around why you care about this topic. And we'll just take a brief moment to look at some of those answers, and that will help inform the conversation. Great. Lots of answers are coming in. So good board governance, staying in line with the industry, ensuring fairness, justice and equity. Oh, this is wonderful. Retention of qualified individuals, board responsibility, healthy leadership. This is terrific. Competitiveness and risk mitigation, retention and equity. So keep those coming. Those are great. But what I want to do is shift, yep, IRS regulations. Exactly. Okay. So a lot of your answers that are coming in align with the 3 reasons we would say you should really care about this subject. First and foremost, we're talking about maintaining a public trust. Secondly, there is risk involved in compensation, and you really need to think about how to mitigate that risk. And third is around ensuring fairness. So when we talk about trust, nonprofits have been given a public trust in the form of their tax-exempt status. And in many ways, nonprofits are dependent on public support to execute on those missions. We know this, whether it's general goodwill, direct donations, or volunteer support. It's important to recognize that trust and to protect it. When the public hears or sees that a charity is paying what they would consider an exorbitant salary, there can be an impact on that organization's reputation and trust that will be hard to earn back. When we talk about risk, there's really multiple competing forms of risk, and you've highlighted some of them in your questions or your comments. One is tied directly to what I just mentioned. What is the risk that you run if you lose public trust in your organization and its work? A second is around legal penalties that your organization can face if it's determined that it's overcompensating its staff. The third risk, which really runs opposite of what I just mentioned, is you run the risk of losing talented staff that are leading your organization well if you don't pay them competitively. So those are really challenging risks to balance together. And then in terms of fairness, you know, we think about fairness at the individual level as well as across the organization. And when setting compensation, you should be thinking about how best to ensure you are paying people fair and reasonable wages. Frankly, it's one of the reasons over the years that GuideStar's compensation report has looked at pay by gender as a way to bring awareness and facts to that issue. So I think we all know these are not hypothetical risks. These are very real risks that nonprofits face every day. These are just a few of the recent headlines from newspapers across the country. And you can see most of them are challenging or highlighting excessive pay issues. Some of them are in defense of executive pay. I would say the bottom line when you look at this is that public scrutiny around nonprofit executive salaries continues to be high, both locally, as you can see from local paper headlines, and nationally, as we've recently seen from the additional fines that were implemented as part of last year's tax reform. So one of the key questions is how do you keep your organization out of the newspaper as you're setting compensation for your staff? One of the key things you can do is to begin getting educated about the rules. And we're going to spend some time talking about the rules around executive compensation today. The best advice we can offer anyone involved in setting compensation at a nonprofit is to take a proactive stance. You need to know the rules both at a state and federal level. You need to seek guidance for your particular situation and take appropriate action. Obviously, no hour-long presentation is going to cover all the rules that can apply to this topic or the particulars of every organization. I'm sure you would agree. My focus is going to be on the federal rules. I have included at the end of this deck links to key IRS pages and documents, as well as some supporting articles and topics related to what we're covering today. In terms of state rules, every state is different. And so I have provided a link at the end of the deck to NASCO, which is the National Association of State Charity Officials. It's a great place to start to find the appropriate contact for the state or states that your organization is working in. So one of the key requirements related to compensation is set out in the IRS code under 501c3, and it is the private inurement prohibition requirement. I like to call it the private benefit prohibition because it's a little easier to say. At the heart of this prohibition is the idea that giving some form of unreasonable benefit, either directly or indirectly, to individuals who have close relationships with the organization and the ability to exercise control over them is unacceptable. There are a lot of different examples of how private benefit can take shape. For instance, it could be the sale of a charity's asset to to what's called an insider or disqualified person. It could be a charity purchasing an asset from an insider. It could be a charity's rental of property from or to an insider, lending of money, use of facilities. But the most common type of private benefit or inurement is excessive compensation. So the courts and the IRS have consistently ruled that any unreasonable benefit, however small, is impermissible and can result in the revocation of your charity's tax-exempt status. That's really the worst-case scenario. However, it's been argued if the private benefit or inurement is clearly present, but is incidental or insignificant, a more appropriate penalty could be the imposition of what's called intermediate sanctions. And that's yet another term that we're just going to take a little bit of time to unpack. The term intermediate sanctions come out under section 4958 of the code. They were initiated temporarily back in 2001 by the Treasury Department, and these regulations became finalized or permanent in the spring of 2008. Intermediate sanctions allow the IRS an alternative to revoking an organization's tax-exempt status in a case of private inurement. Intermediate sanctions essentially give the IRS the power to impose significant taxes on individuals, both the individual involved in receiving the transaction and the people who knowingly approved the excess benefit transaction. It also includes a look-back period, so it's not just looking at a particular year, but it can look back up to 5 years. We're going to take a couple of minutes and talk through a concrete example of what these fines could look like so that you have a better sense of that. But to do so, one of the key things we need to do is define excess. Excess plays a key role in how those fines are applied. I'm going to use this stack of money on the right-hand side as a simple visual to define what we're talking about when the IRS talks about excess benefit. Excess benefit is considered the amount of money that's paid by the charity to an individual that exceeds what is considered the reasonable value of the services provided by that insider to the charity. So when we're talking about penalties, we're talking about penalties in relation to the excess, the amount above what is reasonable. The term reasonable comes up regularly, and it's a decisive factor in determining whether or not the transaction itself violates the private inurement prohibition. And so we're going to come back to that term fair and reasonable a little bit later. So here's an example. Let's say the IRS determines an insider at charity ABC, my super creative charity name, has a total compensation package of $250,000 and has received an excess benefit in that package of $100,000. And that package was knowingly approved by the 8-person board of charity ABC. What does this look like in terms of penalties? Penalties are broken down, I mentioned, into 2 categories. The first category has to do with the insider or the disqualified person who receives this excess benefit. So that person has three components in terms of penalties. The first is that they need to pay back the excess amount they received to that nonprofit. So in this case, that $100,000 needs to go back from that individual back into the nonprofit's coffers. The second is that they need to pay the IRS a 25% fine on the excess amount of the penalty. So in this case, 25% of $100,000 is another $25,000. If that nonprofit is not paid back in the time frame required, the IRS can apply an additional 200% penalty. So you could have a potential additional penalty of up to $200,000 in this scenario. So that's for the individual who received the benefit. The other component has to do with the board's obligations, and the IRS applies a 10% fine to the excess amount for each board member as a penalty. There is a cap on that of $20,000 per transaction. So in this scenario, each board member would personally have a $10,000 penalty and a total of $80,000 for the board as a whole. And again, since there can be a look back period, this could be applied to multiple transactions. It's really important to note a couple of things about different board actions and how they might be considered in the IRS's eyes. So let's see. If you are silent or you show no action as a board member, that is actually considered affirmative action on the part of the IRS. So silence does not in any way mean that you are protesting or contesting the transaction. If you do, however, oppose the transaction and that objection is captured in the charity's board minutes, then the IRS will take that into consideration. There are some additional considerations when a board has engaged a qualified individual and provided full information and then gotten a written opinion on the compensation that also can be a mitigating piece of information. So it's really important for board members to understand their responsibility and obligations and what some mitigating factors might be in that. Oops. So let's shift over and talk about setting compensation. How should nonprofits proceed? We need to balance the risk that we talked about at the beginning of losing talent for not paying, in cases where we may not be paying them as competitively as we should. And we need to mitigate the risk of being fined for overpaying. The IRS allows reasonable compensation. That's a key. So the question becomes, what is reasonable compensation? And what do you need to do in order to be able to prove that it's reasonable? One of the other challenges in this space around the term reasonable is the fact that the IRS provides no standard formula for nonprofits. So there's no percentage of total revenue or expense that allows you to determine what the IRS would consider reasonable. They instead really offer a framework to help nonprofits. So they consider facts and circumstances. That's something that comes up frequently. And they provide guidance on what they consider when they are looking at compensation, what type of process they want to see at a nonprofit, and the type of information that they expect should be used. So it's not a simple matrix or a set of check boxes, but it's really a framework that helps the IRS make some determinations around how the nonprofit has set compensation. And we're going to look at each of those in turn. Let's start by understanding how the IRS defines compensation. Many of us, when we first think about that term, think it's a salary. But the IRS defines this as the fair market value of economic benefits received for the performance of services. All items of compensation are provided in the exchange are taken into account. So common components when the IRS thinks about compensation are naturally salary, but bonuses, severance payments, deferred and non-cash compensation can be included, payment or reimbursement for certain types of taxes or expenses, benefits, whether or not they're included in gross income for income tax purposes, taxable and non-taxable fringe benefits, and so on. This list is actually coming straight from the IRS site. So I bring this page forward just to really highlight that the IRS provides a fair amount of detailed information on its website that is there to help guide nonprofits, guide board members, guide leadership in understanding what the rules are. So there's a link here to this particular page, which really talks about what kinds of things they're looking at when they're looking at compensation. So in addition to providing guidance on what they consider when they think about compensation, the IRS provides nonprofits with a set of required actions that when a nonprofit follows those can demonstrate to the IRS that the charity has shown good faith efforts around compensation. These three requirements, which we're going to talk about next, when they're taken together, form what is called the rebuttable presumption. So keep calm and make a rebuttal is really the tagline for what's critical and next in thinking about setting compensation at your organization. The IRS's rebuttable presumption, again, it's not a specific set of check boxes, but it's a framework. So if you follow these requirements, the payments you make to a disqualified person underneath the compensation arrangement are presumed to be reasonable. There are three components, and there are actually multiple pieces in each component. So the first one talks about that the compensation arrangement being approved in advance by an authorized body composed of individuals that do not have a conflict of interest concerning the transaction. So those three pieces together are the first component. The second is prior to making your determination, making that compensation package, deciding on it, the body needs to obtain and rely on appropriate data that is comparable for the situation that they're looking at. The third thing, which is interesting, and I think a lot of folks don't think about this as much as they should, is the body needs to adequately and timely document the basis for the determination. And again, we'll talk about this in a little more detail. An important thing to note is if you have done those things, in general, you start on a good footing. And the IRS can refute this presumption of reasonableness at that point, but only if it develops contrary evidence to really be able to rebut and show that your data or your process was faulty in some way. So it puts the onus on the IRS. I want to point out, because I sometimes you see these terms, you see language on a website. I want to point out how these rebuttable presumption requirements actually manifest themselves in the Form 990 itself. They are tied to specific questions in Part 4 of the form. So 12A, did the organization have a written conflict of interest policy? Were the officers, directors, or trustees and key employees required to disclose annually interests that could give rise to conflict? That's a key part of that framework. Question 15, did the process for determining compensation of the following persons include a review and approval by independent persons, comparable data, and contemporaneous substantiation of the deliberation and decision, i.e., did you document it at the time it was happening? And then it goes on to list the individuals that should be considered underneath that question. So the IRS is essentially asking every organization each year if it took these steps. One other thing that's important to note is that when an organization, when your leadership signs the annual filing, it's making a sworn statement under penalty of perjury that this filing is true, correct, and complete. So when you check those boxes, assuming you check them, you need to be sure those are true, correct, and complete. Let's take a minute to talk about what those three components mean in a little bit more detail. So the first one, transaction is approved in advance by an authorized body of people who did not have a conflict of interest. So why are they looking for approval in advance? Approving in advance is really demonstrating there's a process and controls in place to make a considered decision before the transaction took place. When you talk about an authorized body, does the organization have a formally documented process, and have they outlined who will be setting compensation? Is that in writing anywhere? Is there a procedure for this? Have members of the committee perhaps reviewed or gone through any training in relation to this aspect of their responsibility? Have you confirmed that the individuals on the board don't have a conflict of interest? This is about making sure that the individuals are making decisions purely based on the interests of the charity and on their fiduciary responsibilities. So for instance, you could see an example where a husband sits on a board of an organization and the wife is a key employee. His involvement in setting a salary is a clear conflict of interest, and the IRS is wanting to know, how are you going to address that if that is the case? Adequately documented. There are actually a number of things that are suggested as part of documenting this type of discussion and transaction. You need to document the terms of the approved transaction and the date it was approved, the members of the authorized body who were present during the debate on the transaction that was approved and who voted on it and what was their vote, the comparable data that you used and that you obtained and relied upon, and how and where that data was obtained. Any actions by a member of the authorized body that perhaps has a conflict of interest and how you dealt with that. So these are some examples of the types of documentation that you want to have in place. And you really need to make sure those things are in place and documented in a reasonable time frame. So what they're really saying in terms of contemporaneously is you don't want to see that someone went back and made up documentation to support a transaction months or even years after it happened. And then third, around data, again, two pieces here. One is that you've obtained the data in advance so that it could be used in a meaningful way. You didn't buy it after the fact. And two, that it's comparable. And that term comparable in some ways feels to me like reasonable. It feels a little bit squishy. So how do you begin to think about what is comparable? When we talk about comparable, there are a number of factors that can and should be considered. So let's just start with job responsibilities. One question I would ask is, does the organization have a well-written job description for the role that they're going to determine compensation on? Does that job description call out the required background, education, experience that's needed for the role? Does it call out the hours that are expected? Is this a full-time role? Is this a part-time role? Is this a shared role? If you're reviewing salary for an existing employee that's been with the organization for some time, it would be important to understand what their performance has been in relation to the goals that were set by the board for them. Is that performance, are those goals and their performance well documented? Another thing that you need to think about is the size and complexity of the organization. Are you dealing with a community arts organization with a budget of less than $500,000 that holds an annual festival every year? Or perhaps you have an organization that is providing critical health services to a large urban community. The type of work the organization is doing and the scale of the organization can drive a lot of complexity, and it can also create the need for specific types of qualifications and experience. Another factor that you can look at is, where is your organization? Are you in a small, perhaps more rural community, or are you competing for talent in an urban setting? Are you in a region of the country that has a high cost of living associated with it? Knowing how those factors, those location factors, might also impact compensation. When you are looking for comparables, these are some of the things you're looking for. Where are there other similar organizations that are paying, and what are they paying for similar roles? So whether you're talking about, and I would argue whether you're talking about executive compensation or staff compensation in general, I would hope that you all would agree that these are great practices, best practices for setting compensation in a fair and transparent way. Before we talk about comparables, I would like to pause and ask you all to participate in a poll. We have just gone through a lot of different pieces around thinking about executive compensation. And so what I would love to do is hear from you. When you think about compensation setting activities that you may be involved in the future, of the things that we've talked about, what will you go back and look at more closely? We are split so far between IRS rules and how the nonprofit documents compensation. Keep them coming. Great. So I think documentation is hitting the top of the list at the moment. We've got a few more folks coming in, but that's great, followed by understanding the IRS and state rules. And the others, a tie for factors when we consider looking at compensation and the data we're using. And last but not least, conflict of interest policy and process. Great. Thank you for taking the time. I think that's really helpful. So let's take a few minutes and talk a little bit about sources of comparable data. Any organization's particular situation is really going to dictate what the best sources for comparable data are from year to year. There are different sources of data available. I have only highlighted a few just to begin to help you think about, where are you getting your data today. The Economic Research Institute has a good source for comparable data. PayScale is another good source for comparable data. I highlight PayScale because one of the things we haven't mentioned is that the IRS does allow you to look at for-profit compensation as well as nonprofit compensation, and I think not everyone is aware of that. The third, obviously, that we're going to talk a little bit more about as we move into this third section of the presentation is the GuideStar compensation report. I can't speak to the details around the Economic Research Institute or PayScale, but I'd be happy to talk through and answer questions around the GuideStar report. And we're going to walk through at least one example of how you might use this report. So when we talk about the GuideStar compensation report, this is a report that was developed and has been produced. It's in its 18th year this year. For the first 17 years, This was authored by Chuck McLean, and Chuck passed this project on to me last year as he retired, and so it's been a great experience for me to pull this report together. It's the only comprehensive report using 990 data available. It's not a survey, it's not a sample. This year's report is based on 2016 fiscal year data, and it contains over 150,000 observations from 990 filings. The report is broken out into two main sections, each with its own particular function and purpose. The first is at the highest level is an annual section, which is showing data for 2016. The second section is an incumbent section, which shows percentage increases for any incumbents that we were able to identify between report years. For each of the main sections, we do a number of different statistical breakouts. So we look at geography, both state and MSA. We look at budget size. We look at NTE categories for any 501c3s. And then we actually include in the report other subsections. So if you're at a 501c6, for instance, or a 501c4, you can find references for those types of organizations in here as well. One other thing, I'm going to go back because I think I forgot to mention this. One other thing that we do is we actually look at a breakout by gender. And so we do that using an algorithm based on names. And that's another way for us to highlight issues around fairness. When we talk about the report provides statistics on 14 different job categories. The positions are coded based on job titles provided in the 990. Obviously, the most frequent and clearly identified is the CEO or executive director role, but there are several other roles that we look at. The second most popular that we have in terms of being able to categorize is the top financial position. But you can see the list here. I'm not going to read it to you, but we work to identify these key positions in the data. The incumbent data that I mentioned a moment ago is based on identifying that a person has a name, a title, and an organizational match year over year. So that's naturally going to be a subset of the annual data. The report provides a number of statistics, and so I want to take just a couple of moments to explain why we do that and what's included. I often get questions about, well, how should I interpret some of these? A key factor in what we provide is dependent on the number of observations in a given breakout or category. So depending on the number of observations, we either have a higher or lower level of confidence, and the higher the confidence, the more detail we can provide in terms of ranges. So consistently, we provide an average. The average can be sometimes susceptible to being skewed, and I'll explain that term in a minute, when there are fewer observations. One of the ways we balance that out is we always also provide what's called a median. So if the average and the median are relatively close together, then that tells you there's very little skewing. But if there's a difference, then the median generally can be a better metric to use. Depending on the number of data points we have, we also include 10th, 25th, 75th, and 90th percentiles. So you can really start to see ranges in the categories that you're looking at. Okay, a good data services person or data science person can't miss the opportunity to talk briefly about a distribution model. So this is just an example. If you were to imagine that you had, let's say, 100 people in a category and you were looking at their salary, you can see on the screen that the majority of those individuals are to the left, but there are a few way out to the right, and those can skew the average. So this is an example of what we would call a positive skew. And it basically means that those folks out to the right, even though there are very few of them, their number is so high that it pulls the average up. And in this case, the median, which basically says where is the 50th person in this distribution, can be a better initial frame to consider and to look left and right of. See, that wasn't too bad. Okay, so let's just take a look at a couple of sections of the report and think a little bit more concretely. Let's say you are running a human services, or you're part of a board at a human services charity in Florida with a budget of $500,000 or less. How do you find some comparables for your executive director role? In this year's report, we have 205 individuals that are falling into that category in the state of Florida, with a median compensation of $44,884 and then a range, if you look at it, 25th to 75th percentile of $31,000 to $57,000 in round terms. So that can be a helpful data point, and you can see how that compares with an organization below that is perhaps working with a larger budget and a more complex operation, where the median is higher and the range is also adjusted accordingly. So obviously, Florida is a big state and compensation can fluctuate within a state. The GuideStar compensation report lets you in certain places drill down into MSAs. So this second example takes a look at that same breakout for Orlando, Florida. Now you can see that we've moved from 200 organizations to roughly 25 organizations that are in that category. And the median is slightly lower than the state overall in both categories of both budget categories. So when you think about the IRS's concern with excess benefit, you can begin to see how this type of information could help your board get a sense of what your exposure might be. If you look at the median, the further away from the median you get, the more likely it is you're going to attract some attention or some scrutiny, and the more careful and detailed you'd want to be in documenting why your compensation is one way or the other. It may be that you have a very experienced person, that they have the right training or certifications you're looking for, and that those things lean them up into the 75th quartile. That could be a good explanation. One other view that we offer in the report is another click down into the NTE codes. So I'm going to just take a moment and show you that. In this case, we're now still in Orlando, and we're looking not just at human services generally, but some of the different categories. So children, youth services, emergency services, family services. In these cases, we don't have enough observations to break out by a budget range. And so this is just another frame that lets you take a look and further assess where your organization might reasonably come in. We often get the question, when should I use the GuideStar compensation report? And I would actually start with a question back to you. Is your organization's compensation package complicated? Is it perhaps well above the norm? If the answer is yes, then I would say the report is not sufficient in and of itself to meet the rebuttal presumption requirements that the IRS has. If, on the other hand, your organization does not fall into that category, and you would say we really stay within a general range, it's not a complicated package, it's not a high package, then I would say this report can be a very useful and solid source of comparable data for you. So it's really, really important to be rigorous about your process, to be clear about the people that are involved, and to assure that they're independent in making their decisions. The documentation of your process and decisions needs to be done in a timely and contemporaneous manner. And the data you use also really matters. So knowing the rules, knowing your responsibilities in the role that you play, both from a state and a federal level, can make all the difference in helping your organization to attract and retain the right talent, and to stay away from issues or concerns or scrutiny around compensation. There are a number of really good links in the back of this presentation. I'm not going to go through them, but those will be available. And what I'd love to do at this point is just open up the forum for questions.
All right, Holly, excellent job. And we do have a few questions coming in. There were a lot closer to the beginning of the presentation about D&O insurance, directors and officers insurance. So could you talk a little bit about D&O insurance and if that will pay for any sort of imposed penalties or if it covers board members who approve compensation for executives?
That's a great question. I will say candidly, that would be something that I would want to take some time to research. And it's the level of question that I think really would make sense for the board to do some research on, to seek some legal counsel on. It is probably very much dependent on the particular situation and type of compensation package that the organization is proposing to put in place.
Okay, great. That's a great answer. There were a few questions about the GuideStar compensation report. Let's see. One of them was we have a lot of questions coming in.
That's great.
Holly, if you use the compensation report, it has data from 2016.
Right.
Is there any need to, when determining compensation for an executive, to add like a percentage to the median number?
That's a great question. Yeah, it's a great question. So obviously there's a range that is visible when you're looking at a particular category. I think the incumbent data, which shows percentage change, can be useful in thinking about what might be a bump above that amount. But the ranges are generally pretty broad. I think you can look to your area and some of the reporting around inflation that's coming out annually to make a determination that does this need to tweak up a little bit to address the lag in the data. I think that's a fair thing to look at. And I think if you are clear in what sources you're using to make that adjustment, then that would probably be considered acceptable.
Excellent. Thank you, Holly. Let's see. Oh, here's a good question. How frequently should compensation policies be reviewed? And is there any sort of guideline on how often comparable compensation studies should be done, particularly with an executive?
Yeah. So how often should the policies be reviewed? I think that depends on the size and the scale and the complexity of what you're doing. And if you're, for instance, growing rapidly and maybe facing some new scenarios, then you would want to do that review on at least an annual cadence. If your organization has a fairly mature policy in place, maybe it's something you do every other year or every third year. When you talk about comparables for someone who's been on staff for some extended period of time, if you're making a substantial change to the compensation, then I think you definitely want to be looking at comparables and having making sure you have really solid documentation. If you're doing something in a given year that's more along the lines of a cost of living increase or something that's very modest in nature, then you may be able to get away without going through an exercise of gathering full comparable data. So I think the questions are really around, how much change is your organization seeing overall? How mature are your policies to begin with in your procedures? And then what kind of changes are you talking about in the compensation package? The more change you're talking about, the more likely you would want to really go through a full process.
Okay, excellent. All right, let's see here. I think we have enough time for about 2 more questions, and
Okay.
then we'll wrap it up and we'll call it a day here.
Great. And, I can see a lot of questions coming through. So what I'm happy to do is to scan through these after the session. And if there are some common themes in here, and I can provide some additional insight or information on those frequently asked questions, then I'll be happy to do that.
Okay, that'd be wonderful, Holly. So we'll choose 2 more questions, and then we'll see if we can have some follow-up after this as well. So, Holly, with that, who can be part of an authorized body that approves executive compensation?
That's a great question. So I would need to do some additional research to give a comprehensive answer, but the first key point is that this really is a board responsibility. And so it really should involve at least a subset of the board as a compensation committee. There may be some other individuals that are involved in helping to facilitate the process in some way or provide data at the request or direction of the board. But typically these compensation committees should really be driven by the board.
Okay, great. And we're seeing a lot of questions about the GuideStar compensation report. So 2 things to address this. You can learn more about the GuideStar compensation report at guidestar.org/compensation. We will also be sending a link to learn more about the compensation report and the follow-up. So for those of you who are curious about it, you'll have a resource in the follow-up message with the recording about how you can learn about the compensation report. Let's see here. Last question. Holly, what is the penalty for executive compensation? And is there a limit to how much someone can be fined?
So the individual receiving the excess benefit, to my knowledge, there's not a cap on that penalty. The board penalty does have a cap of $20,000 per individual involved per transaction.
All right, thank you, Holly. And with that, we will call it a day here. Thank you so much, everyone, for joining us today. And once again, we'll be sending out a follow-up with this recording so you can share it with your colleagues and review it as needed.
Great, Jesse,
thank you. Out. Yeah, and thank you, Holly, for an excellent presentation. Goodbye, everybody. Great.